This is Nightly Business Report with Bill Griffith and Sue Herrera.
Brokerage blockbuster Charles Schwab is reportedly in talks to buy TD Ameritrade, further consolidating an industry undergoing massive change.
Macy's mess, sales slip at the department store, and the retailer blames warm weather and weaker mall traffic.
Drug discovery, how artificial intelligence is being used to drive the next big medical breakthrough. Those stories and much more tonight on Nightly Business Report for Thursday, November 21st.
And we do bid you a good evening, everybody, and welcome. A reported mega deal in the brokerage industry caught Wall Street off guard today. According to reports, Charles Schwab is in talks to buy one of its biggest rivals, TD Ameritrade, which would create a massive firm with more than $5 trillion in combined assets. The move could tighten Schwab's grip on an industry that's already been upended by zero-fee commissions, a trend that was started by Schwab itself and one that effectively killed a key source of revenue for the whole sector. News of the potential tie-up sent shares of TD Ameritrade up nearly 17% today. Schwab was even up 7%. Mike Santoli takes a look at why these two companies may want to become one.
Technology continues to drive down the cost of investing, and it reflects the push for greater scale in an investing industry dominated by low-cost index funds, zero-commission trading, and a multitude of digital startups vying for the investment dollars of younger consumers. Schwab was a pioneer in low-cost brokerage from the dawn of the industry in the 1970s, and its brand has consistently been to make investing more affordable and accessible. Ameritrade, the product of numerous mergers earlier, had become a sizable competitor. Together, they would house about $5 trillion in client assets across stocks, bonds, funds, and bank accounts. In recent months, Charles Schwab led the way to zero commissions, a move that hurt shares of Ameritrade more due to its greater emphasis on trading volumes. Getting together would also position the companies better in a low interest rate world. These brokers rely heavily on collecting interest on customer cash balances, which has been pressured by rate cuts. The willingness of retail investors to invest through a mobile app or allow a software model to determine a proper portfolio allocation means leading companies must constantly upgrade their technology offerings and advertise heavily to pull in new accounts. Brokerage startup Robinhood and automated investment advisors such as Betterment and Wealthfront have won the backing of Silicon Valley investors to capture a younger, digitally attuned cohort. Schwab has become more an asset gatherer and wealth manager. Joining Schwab with Ameritrade could eliminate about half the combined company's operating expenses, according to some analysts, which helps explain why the stock market applauded the reported deal, driving up share prices of both firms. While mergers often reduce industry competition, in this case, a combined Schwab Ameritrade would continue to fight even larger competitors, Vanguard and Fidelity, for customer dollars and loyalties. So in this case, the individual investor could continue to benefit from the race to make investing ever cheaper, faster, and easier. For Nightly Business Report, I'm Mike Santoli.
And let's turn now to Michael Wong to talk more about what a potential deal between Charles Schwab and TD Ameritrade would mean for the rest of the online brokerage industry. He's an equity analyst over at Morningstar. Welcome, Michael. Nice to have you here.
Thanks for having me.
What do you make of this potential deal, and does it make sense to you?
Yeah, of all the potential mergers with the publicly traded online brokerages, this was probably the least likely. The market was betting likely that E-Trade would merge with the TD Ameritrade or E-Trade would merge with Charles Schwab. And I think that the nearly 17% pop in TD Ameritrade and the drop in E-Trade are about proof that this was unexpected.
Yeah, that E-Trade was down sharply today. You might have thought it would go up in sympathy, but it had already gone higher, anticipating maybe a deal something like this. So does this take E-Trade out of the story, or do you think there are other mergers coming?
I think that E-Trade is still in play. Besides just the regular industry consolidation of them, merging with, let's say, a Schwab or a Ameritrade, we think that they could potentially merge with a regional bank or even a wealth management firm. So there's still plenty of players out there that would find a lot of value in E-Trade's retail trader base and their employee stock plan business.
Mike Santoli in our report outlined, if indeed this deal did happen, some of the positives for the two companies involved. But are there negatives if indeed this deal does happen?
There could be a little bit of a culture clash. TD Ameritrade has been well known for a very large kind of open architecture platform, whereas Charles Schwab has had like a more vertically integrated platform where they have more of their own products on there. And definitely a big hurdle for this merger potentially is Toronto Dominion's ownership stake in TD Ameritrade, and Charles Schwab having to potentially untangle that relationship between Toronto Dominion and TD Ameritrade. If
this deal happens, they end up, as we mentioned, with $5 trillion. That surpasses Fidelity with the amount they've got, about $2.6 trillion. Does Fidelity need to step up now, or anybody else of the giants in this industry?
Yes, so Fidelity can definitely be a player that can challenge this Charles Schwab TD Ameritrade merger. That said, I think that there are many other players that may be considered a little bit less traditional, like Bank of America and Merrill Lynch with its Merrill Edge platform, JP Morgan with its UInvest platform, or even Robinhood. So there's still many players out there that can go head-to-head with a potentially combined Charles Schwab TD Ameritrade.
Just very quickly, do you see any regulatory hurdles at all?
Definitely, you could see some anti-competition hurdles coming up. They are some of the most well-known online brokerages. They do have a really good hold on the investment advisor space for RIAs. So there's definitely going to be some industry concentration that I think regulators will be looking at.
Michael Wong with Morningstar. Thank you, Michael. Appreciate it. And a bit later in our program, we'll take a look at how such a merger could potentially impact those who use discount brokers to invest.
To Wall Street now, the Dow and the S&P posted declines for a third day in a row, their longest string of losses in months. New reports on trade negotiations between the U.S. and China continued to pressure stocks. We'll have more on that in a moment. But first, the closing numbers for this day, with the industrial average down 54 points, still below 28,000. NASDAQ was down 20 today. The S&P was down nearly 5.
And to the economy and the housing market, sales of previously owned homes rose 1.9% last month. It's the latest report to show the impact of lower mortgage rates. The report also shows that the median sales price of a home was up more than 6% to a little bit more than $270,000. And this reflects a trend we've been telling you about, that the supply of homes is falling well short of demand, and that is driving up prices.
And to retail now, it's been a big week for earnings, as you know, and today it was Macy's turn to report. The department store reported better than expected earnings, which is a good thing, of course, but its sales were weaker than expected, and that sent the stock down more than 2% today. Courtney Reagan has details.
The magic wasn't with Macy's in the third quarter. Sales fell worse than expected, the first decline in 2 years, which led the department store to slash its full-year outlook to reflect this quarter's weakness. While digital sales grew, the quarter also marked the end of 40 straight quarters of double-digit online growth. Macy's blamed the slide on several factors: a warmer fall, which made it harder to sell cold weather items like coats and boots, lower spending by international tourists, weaker than anticipated performance in, quote, lower tier malls, and there were brief issues with the website as it made changes ahead of the holiday season. CEO Jeff Gannett told me the U.S. consumer is, quote, healthy. They have set the bar high for all retailers. We have to earn their trust and their business every day. And added, quote, we know Macy's fits into the consumer consideration set. But analysts aren't sure.
What we worry about is really women's apparel. That's been a very tough category. Also, it's a highly promotional quarter with other retailers really competing for that dollar.
The consumer wants value, they want brands, and they're going to places like TJX, they're going to Target, they're going to other places other than Macy's.
One thing Macy's did differently than competitor Kohl's this quarter, decided not to discount more than planned to chase sales, which did help protect margins and led in part to stronger earnings.
There are bigger picture issues here, specifically the future of the mall. As you know, mobile is the new mall. And as you know, the female shopper is so different now with a real Instagrammable generation that's interested in speed and trend and value.
On its conference call, Chief Financial Officer Paula Price said Macy's expects sales will improve in the holiday quarter and that the department store remains, quote, confident in its holiday plans. There's a lot riding on next week for Macy's, the most important several days of the year for the retailer. Its annual Thanksgiving Day parade is a huge marketing event. And then hours later, its stores open for Black Friday and the holiday season gets underway. For Nightly Business Report, I'm Courtney Reagan.
It is time to take a look at some of today's upgrades and downgrades. AMD was downgraded to market perform from outperform at Northland Capital. The analysts expect some profit taking in 2020. The price target is 36. The stock fell 3.5% to 39.52. But that stock has more than doubled so far this year, and that makes it the best performer in the S&P 500. Carnival Cruise Line was downgraded to hold from buy at SunTrust Robinson Humphrey. The analyst cites recent analysis of its bookings and price cuts. The price target is $47. The shares fell a fraction to $43.02.
RH, formerly known as Restoration Hardware, was downgraded to hold from buy at Loop Capital Markets. The analyst cited that stock's valuation. It's had a very big run this year. Price target now $190. The stock continued higher, though, up more than 2.5% now to $195.08. And Duke Energy was upgraded to overweight from equal weight at Barclays. The analyst cited the stock's valuation following a nearly 10% decline over the past month. Price target now $98. That stock was down a fraction to $86.66.
Still ahead, the next major medical breakthrough and how to pay for it. In Washington, House Speaker Nancy Pelosi cast doubt on the possibility of passing the new NAFTA trade deal, known as the USMCA. She had previously characterized an agreement as imminent, but today she said she's not sure there's enough time to finish before the end-of-year timeline many had hoped for.
Well, it's also unclear whether the U.S. and China will be able to finish phase one of their agreement by year's end, and whether a reported invitation to meet face-to-face will be accepted. Here's Eunice Yoon with more.
The Commerce Ministry said today that China wants to have a phase one trade deal, but one where the two sides work out their core issues as equals with mutual respect. The Wall Street Journal is reporting that China's chief negotiator Liu He has invited his U.S. counterparts to Beijing for another round of face-to-face talks, possibly before Thanksgiving. But it adds that the U.S. team isn't keen to come unless they have firm commitments from China on issues like agricultural purchases. Meanwhile, China's top diplomat is warning that the relationship between the U.S. and China could suffer because of the passing of the Hong Kong bill in Congress. The foreign ministry said the U.S. should stop before it's too late. And the state paper, the People's Daily, says that China could take resolute revenge if the bill turns into law. For Nightly Business Report, I'm Eunice Yoon in Beijing.
The Senate today passed a short-term spending bill that will keep the government open. The measure funds the government through December 20th. The House already passed the bill earlier in the week. The legislation gives lawmakers time to work through some issues, like the funding level for the White House's border wall. And tonight, the president signed that bill.
A new report concludes what we have all suspected anyway, that health care premiums and deductibles have outstripped wage growth over the past decade. The report was prepared by the Commonwealth Fund. It found that in 42 states last year, employer premium contributions and deductibles exceeded at least 10% of the average income. That was up from just 7 states in 2008.
The future of medicine was being discussed today on the campus of MIT, a place that many consider to be the heart of biotech. Doctors, investors, and executives all converged for the first ever STAT Summit to find ways to push the limits of what's possible in healthcare. Our Meg Terrell was there.
Artificial intelligence was a key focus. Daphne Kohler, CEO of AI startup Incitro, said the technology can enable things humans can't do.
It turns out that computers are much better at seeing these subtle signals in cells than people are, and they're also a lot less biased. They don't come in with a preconception of what makes for a good or bad intervention or what makes for a sick or healthy cell, and therefore they find patterns that people will never see.
Her company is working with drug giant Gilead to find new medicines for the liver disease NASH. Industry experts also weighed in at the conference on new approaches to cancer, Alzheimer's disease, and depression.
We've already completed 2 pivotal programs, one in major depressive disorder and another in postpartum depression. Both of those showed very rapid response and durability of response, even though we only used the drug for 2 weeks.
But as the industry is pursuing its highest science yet, it's also grappling with an existential problem, its reputation. Nick Leshley, CEO of Bluebird Bio, said the industry's poor standing with the public is partly its own fault, as some companies, primarily makers of older biologic drugs that draw billions of dollars a year, reap outsized profits.
We need to make sure that the reward over time actually is not egregious, right? And that's what we're trying to make sure the upfront industry is doing better at, and it's not. There's some behaviors that still go on in our industry that are simply not good enough.
His company, which is still unprofitable, just introduced a new one-time gene therapy for the rare blood disease beta thalassemia. Its price, $1.8 million. But he argues that price makes sense for a one-time treatment for a very rare disease.
If we have a whole bunch of cures that come out through gene therapy and other modalities, as a human being, that's exactly where we want to go. You're right, we have to figure out how do we pay for it. But don't forget, all these diseases cost an amazing amount of the system. So if you zoom out one notch and say, paying a certain amount up front for a potential cure, and then they have a lifetime savings, the pharmacoeconomics, or sort of what should you be willing to pay for that, actually on each of these medicines is tremendous.
Meanwhile, Washington is at work on drug pricing as well. Industry CEOs said a plan from House Speaker Nancy Pelosi to cap drug prices would mean Wall Street interest in funding new medicines would slow.
The vast majority of work to develop a drug comes from private resources. I think if it's highly risky. Of course, you'll have a chilling effect on investment.
To avoid more regulation, the industry says it needs to be better at self-policing. For Nightly Business Report, I'm Meg Terrell in Cambridge, Massachusetts.
Xerox is not taking HP's rejection lightly, and that's where we begin tonight's market focus. We reported earlier in the week that HP had turned down Xerox's acquisition bid, saying it undervalued the company. Well, now Xerox has sent a letter to HP's board threatening to take its $33 billion bid directly to HP shareholders if the printer maker does not reconsider by Monday. Xerox rose about 1.5% to $38.69, while HP was down a fraction to $19.65. Will Tiffany say yes to LVMH's new proposal? The French luxury company that owns Louis Vuitton and Christian Dior reportedly has upped its bid to take over the iconic luxury jeweler. Reuters says the new offer is 8% higher. Tiffany shares rose more than 2.5% to $126.50. And ExxonMobil is reportedly increasing the size of its asset sales to $25 billion. The plan focuses on major oil and gas projects it has in Europe, Asia, and Africa. Reuters says that Exxon is preparing sales of in at least 11 countries in order to improve its cash flow. Shares rose more than 2% today to $69.67.
After the bell, the Gap topped Wall Street estimates, but the clothing retailer did see a drop in comparable store sales and global demand. The Gap also said it is making progress with its separation plans from Old Navy. Gap shares initially rose in after-hours trading after closing the regular session down a fraction to $16.22. Also after the bell, Nordstrom posted better than expected earnings and revenue was in line with estimates. The retailer saw a decline in department store sales, but growth in online revenue. Nordstrom also raised its guidance. Shares initially rose following the news. They closed the regular session up about 1% to $34.32. Williams-Sonoma also reported after the bell. The parent company of Pottery Barn and West Elm had sales come in slightly above estimates, while profits were in line with forecasts. The retailer saw an increase in same-store sales and raised the lower end of its full-year outlook. Shares initially fell in after-hours trading after closing the regular session up a fraction to $68.75. And finally, Ross Stores topped analysts' expectations after the bell. The discount retailer had a spike in same-store sales and raised its full-year outlook. Shares initially rose after hours. They closed the regular session up more than 1% to $111.79.
Now back to our top story tonight, that Charles Schwab is reportedly in talks to buy rival TD Ameritrade in a deal that would create a massive brokerage and asset management company. So what would this deal mean to investors who have accounts with either of these companies? And what happens when your broker is gobbled up by another company? We join now Reed Frassa. He's financial planner with Highland Financial Advisors to get us some answers here. Welcome back. Good to see you again.
Good to see you, Bill. Sue, thanks for having me.
Nice to see you.
Now, again, this deal hasn't happened yet, but even if it were to be announced, let's say tomorrow, customers wouldn't see changes for quite a while, right?
That's right. It takes quite a while. Full disclosure, we're an advisory firm. We work with both of them.
Okay.
So it affects the institutional side and the retail side. So yeah, this is probably likely to happen. And we think it would be a very strong fit for the two companies. They both have strengths in both areas. So for the average investor, what's probably going to happen is similar to what we saw happen about 2 years ago when TD Ameritrade bought Scottrade. Right. So the lawyers get together, they go through regulations and legalities, and eventually they close the deal. And then you have the back offices working on, the technology integration.
So if I have an account with either one of those two firms, what differences might I see? What changes might I see? So
Schwab, we believe, is buying TD Ameritrade primarily for their technology and the assets. Zero commissions. They have to find other ways to make money. Right. Basically, these companies make money off, cash accounts. So it's in their best interest to make the retail and institutional customers very happy through this process. As a retail investor, you probably deal with the local branches for your accounts. TD Ameritrade, when they bought Scottrade, they have increased by about 3 times the number of offices. They have one of the largest networks of offices now. So the average person is probably not going to see too much change until after that point when all the technology, because you have a lot of data that has to be integrated, tax, transactions, it all has to be integrated in the back office first, and eventually they'll probably throw a switch. And whoever's the dominant technology player, you will just log in one morning and you'll have a new login.
Very quickly, TD Ameritrade tends to use products that are made by other companies.
Yeah.
Schwab has its own products, its own mutual funds, its own ETFs. Right. Who wins in that one, do you think?
Well, that goes back to how they make money. They both took a big hit on revenue when they stopped charging on transaction fees. So for mutual fund trades, you're still going to pay. But they also make money on spreads on bonds, but cash is where they make most of their money. So when they consolidate, they're going to have probably about Schwab will have a 40% increase in their assets. If interest rates start to go up again, they have a big windfall. So they're in a great position. The good thing for investors is with that additional revenue, it's likely that free trades are going to remain.
Well, we certainly hope that's the case, that's for sure.
Yeah.
Reed, always good to see you. Thank you for joining us.
Thank you very much.
Reed Frossett with Highline Financial Advisors. And coming up, missed opportunity, a federal initiative meant to help poor neighborhoods may actually be benefiting the rich.
Here's a look at what to watch for tomorrow. President Trump is scheduled to meet with the vaping industry as he considers a ban on flavored e-cigarettes. On the economic calendar, we'll get fresh reads on manufacturing and consumer sentiment, and we get one more retail earnings report, this one from Foot Locker. That's what to watch for on Friday.
In the meantime, Facebook is reportedly considering making changes to its political ad policy. According to the Wall Street Journal, some of the changes would include preventing campaigns from targeting a small number of people. The goal is to curb the spread of misinformation.
WeWork is laying off 2,400 employees. The beleaguered office-sharing startup is working to cut costs and, quote, create a more efficient organization. The job reductions represent about 19% of the company's total workforce, and those job cuts had been widely expected.
Finally tonight, remember opportunity zones? They were billed as a way to redevelop low-income neighborhoods around the country. The idea was received bipartisan support. But now some are calling these zones a missed opportunity. Yolande Mui explains.
Opportunity zones were billed as a bipartisan way to help poor neighborhoods attract billions of dollars in new investments. And Senator Cory Booker told CNBC this summer that he was on board.
We have got to make sure that this economy is working for the ideals that we talk. That's why I passed a piece of legislation with Tim Scott across the aisle for opportunity zones.
So were several of his fellow presidential candidates. Mayor Pete Buttigieg championed the program as a way to drive inclusive growth in South Bend, Indiana. Entrepreneur Andrew Yang was part of the think tank that came up with the idea. But now the political winds are shifting. What was once one of the only bipartisan provisions of the new tax law has come under attack as a handout for the wealthy. Take this Opportunity Zone investment fund founded by Anthony Scaramucci. In this presentation for potential investors, the first project is in a trendy neighborhood in New Orleans. The new Virgin Hotel is an experiential lifestyle property with a premium room product. The minimum investment, $100,000.
We've got to have some limits on the type of investments.
Investors get to defer taxes on any capital gains they put into an Opportunity Zone. They also become eligible to discount those gains by up to 15%. And any money they make on their Opportunity Zone investments, it's tax-free.
The pool of unrealized capital gains, which is the source of capital for investment opportunity zones, is about $6 trillion. You really only need 1% or less of that capital to have a program that creates a major new marketplace.
But that's a major new problem for another presidential candidate, Bernie Sanders. He tweeted, "We're going to end this tax scam and invest in working-class communities that have been fleeced." As for Booker, he's now sounding the alarm as well, writing a letter to the Treasury Department warning that reports of abuse would be a perverse violation of public trust. For Nightly Business Report, I'm Ilan Mui in Washington.
And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.